And while the Fed waits to study the effects of their previous rate hikes, Wells Fargo's Chris Harvey says only the Federal Reserve will be able to put a pin in the tech rally. That's at least according to Bloomberg. For more on this, let's bring in Lee Munson, Portfolio Wealth Advisors President and CIO. Lee, going back to those Chris Harvey comments, he said specifically that he's starting to see similarities to what we saw back in 99 as well as 2000. Essentially that it's the Fed's aggressive move. They would have to break the economy in order for the tech rally to roll over. Is that what you see?
Wouldn't that be nice? Wouldn't that be nice if it was just the Fed that was going to be a problem? It wouldn't have to do with the level of interest rates, because this guy just came on today and told Congress that he's going to take his sweet time on if they raise a little bit, but he also is trying to, imply a little bit that he's going to take his sweet time lowering rates. High rates are not healthy for long duration assets, and that includes big tech and long 30-year treasuries. So this isn't where I necessarily want to be if it's going to be another year or 2 years where he's going to keep this federal fund rates high. I'd like to look at something else. And a lot just because we've had such a run up in some of these big tech stocks, and that's what's leading. I need to see more breadth in the market. Everybody talks about it, but what are we talking about? I need to see the actual stocks that have to do with the economy start to rally here. And they have, but I need to see us to get overbought, sell off a little bit, and then get overbought too. And we got to get through next earnings because we still have bears saying the economy's, going to crap. I'm not seeing that outside. All I see is profit margins at risk.
Well, let's stick with earnings for a second because the last earnings season, the analyst community largely got wrong. Really, a lot of those beats were incredible, and that, I would say, in part fueled this incredible rise. There are other tailwinds in the market right now, but what's your projection in a month when we're staring at Q2 earnings?
Well, here's the thing. Obviously, the street thinks Q2 earnings are going to be just fine. Obviously, status quo says, consensus says, we brought down earnings enough, 10, 15, 20%. What's going to be the problem in Q2? But that's a problem is that we've richly valued some stocks as if there's going to be not just next quarter, but we're talking about multiple years of massive outside gains, partially because of this thing called AI. Because remember, January we were talking about going into the end of January, everything's going well. We said, well, we're buying these big tech stocks based on Fed cuts at the end of the year. And now it's like, oh no, there's not. Now it's because they're AI and we're gonna have all this productivity thing. So I don't doubt that Q2 is probably gonna be good, right? I think Bank of America, I think you see some beats in economically sensitive stocks, right? But the real question is, 6 months from now, are we going to see those interest rates starting to hamper not the economy, not surging unemployment, not caving housing prices, not raging energy prices, but are we going to see it start eroding those profit margins that came from cheap money, cheap wage, no wage inflation, cheap energy and commodities? And we're going to get to see, we'll put it this way, in a month we're going to get to see how the economy's doing by looking at Bank of America's earnings, getting in their loan book.
That doesn't sound as sexy as AI, right, Lee?
No, it doesn't. Who wants to be a value player this year?
Let's talk about Goldman Sachs lowering the odds of a recession in the next 12 months. But as bets on the U.S. economy remain uncertain, there is one tip for investors who are looking to buy. Global investors set their sights on Japan's stock market as they look to catch a boom, aiding in the Nikkei 225 index rising to almost 30% this year. Japan is the market, Lee, we keep hearing about in terms of overseas. We've seen Warren Buffett increase his holdings, at least in the trading conglomerates that exist there. How do you view that market right now?
I started going long a couple weeks ago, and I'll tell you why. As I age, I don't always feel like I have to buy something right at the bottom waiting for a turn. Sometimes, as Druckenmiller would say, you get in at the third inning of a baseball game. I love that the yen, 141 today? My eyes deceive me against the dollar. So they have cheap yen. They have some new governance things where they're being forced to get, all this cash that's sitting in these Japanese firms invested. And I think for once, we might have a 1 or 2 year breather of Japanese people's 100-year recession. They are the number one exporters out to China. They've taken place of the United States because they don't have the big political issues that we have with China. They're going to be selling to China for several years going forward. They even have a tiny little bit of inflation. If you can just look real hard, it's just real small like Hello Kitty. So I started taking a quarter of my emerging markets. Yes, why emerging markets? Because, I obviously have a hole in my head, but I took a quarter of my holdings and I shifted it over to Japan because it seems a safer bet than betting directly on China. I'm more interested in the flow. I want to get out of valuations. I want to get out of a Chinese, communist, structure, blah, 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 blah. I think Japan could be a winner, and I think it's still got legs, and it's super cheap. Any value investor would look at this and say, oh my God, there's a margin of safety here.
Yeah, so we're talking about valuations here. Sure, largely, the Japan story has been about the structural changes that have been happening over the years, particularly around corporate governance. But I wonder if there's a particular sector you've been honing in on. But you look at Warren Buffett, he's really investing in the older part, the legacy businesses, you could argue, in Japan. Where are you putting your money?
Well, a few years ago, I got quite interested in some of the commodity trading companies that some of his younger people, it's a relative term over at Berkshire Hathaway, that they're interested in 2020. But I really don't. I understand that there's a lot of value players that have been looking at Japan, especially, Japanese small cap, since like 1989. I would really prefer not to stick to a particular sector. I do think that if you need particular sector, there's stuff in tech, there's stuff in high-end manufacturing that I think is going to really increase possibly some of those valuation multiples. But I would caution people. Right now, we just have a reawakening. There's this country called Japan. It's a massive economy, and it's super, super cheap. And I would leave it at that and buy something broad base and wait for another 6 to 12 months to really see if you get some particular sectors outperforming. Because remember, with the yen this cheap, with exports so pumped up right now, with that governance thing, everything should be a winner in Japan.
Lee, I love this topic, and we don't talk probably enough about Japanese equities here because they haven't been interesting really for a long period of time. But can we go to the Wi-Fi Interactive? I have a chart of the Nikkei going back to the late 80s, and we are short of the highs. You talk about that centennial recession. It's been 3 decades. Yeah. 3 lost decades here, and they're finally catching up. But are you worried something's going to break over there? We talk about the Fed breaking things, but they have arguably a bigger house of cards that could come tumbling down a little bit harder.
That's why I think it's important that you have such a huge discount in valuations. And that makes me more comfortable. But this is the smallest position in my portfolio right now. I just started getting exposure. And so what's going to have to happen is we're going to need to see a breakout. I need to see it close to 1989 again. And right there, that's where the point is, right? My first buy is right under it. But if this thing can hover around there and start breaking up and then fill in and break up and fill in and break up, then I think you have a winner. Just like the NASDAQ was, 10 years ago trying to get back to 5,000. But they have so many policy errors that they could make, right? And so you have to buy this stuff when it's 30, 40, 50% cheaper valuation than the US. And by the way, don't listen to these Japan bulls. They're like, oh, when it's a premium to the US, that's when you sell. No, it's when people start saying, gosh, you could see a premium to the US about a mile down the road. You say, I'm out now. Forget it, because I don't think it's ever worth a premium to the US.
Be a little bit forward leaning there.